Good day from Toronto, Canada. I'm John Ciampaglia, the CEO of Sprott Asset Management, and it has been an incredibly busy year in all things metals and mining, particularly in the world of precious metals, given all of the trade uncertainty and trade wars and tariffs going on. They've definitely had an impact on metals. And the big winner so far this year has been gold, and obviously the gold stocks have really come to life, which is great. And we have been incredibly busy with managing our suite of funds that cover the whole gamut of gold, silver, and related miners.
Fantastic. I might even touch here on uranium in this conversation too. We've had a lot of inbound from people who not invested in natural resource space, don't really kind of understand the thesis for a lot of these metals. And as you say, I guess the thing that's dragging them in is the conversation around gold price. Explain why gold has been reacting like it has. Why don't you start with the basics?
Yeah, so gold is obviously an alternative asset. It's an alternative to paper forms of money, and we view it as a monetary metal, not as a commodity. And given all of the uncertainty going on in the world right now and some of the emerging portfolio risks, gold historically has not just been an incredible store of value, but it has been a safe haven asset in these times of turbulence. If you go back in history and you look at all the different financial calamities, whether it was the 2008 or 9 financial crisis or the tech meltdown of 2000, gold has been kind of a safe haven asset, which has provided very low or negative correlations to traditional stocks and bonds. So we always view gold as a strategic asset allocation, not a tactical one. We view it as the ballast in your portfolio. It helps you sleep at night and helps to offset some of the risks that we're obviously seeing right now with extreme volatility in equity markets, bond markets, and even currency markets. So it's a long-term store of value and also a very effective portfolio diversifier.
Right. Okay. And I guess there's lots of different ways that people can look to invest in that. I mean, recommendations from you would be what if I'm a retail investor?
So the Sprott Physical Gold Trust is our flagship product. It just crossed, I think, $11 billion US in size. It's been a very popular product with everyone from individual investors right up through to institutional investors. And why the product has been so, I think, successful over its inception back in 2010 is that it's very simple. It holds 100% physical gold in allocated form and stored at the Royal Canadian Mint in Canada. So in terms of having the comfort that the physical gold is all there backing the units that trade on both the New York and Toronto Stock Exchange and stored outside of the banking system, which for many investors is another way to reduce counterparty risk in these uncertain times, it's been a very popular choice. It's very easy to buy, sell, and trade, as I said, on both the New York and Toronto Stock Exchanges.
Right. And if we look at the things that could affect investment in gold now, I mean, gold's gone on a real rip at the beginning of 2024, about around $2,000. We're sitting here, have we hit 3,300 today?
I think yes, I believe we're at a new all-time high today as we're recording this.
Right. Okay. With those kind of amazing surges, sometimes come, as quick fall-offs. Do you expect to see that anytime soon? And if you don't, what's going to keep it up there?
Well, it's very hard to predict. Obviously, the volatility in the market right now is at extreme levels. Last week, I think, was just absolutely unprecedented in terms of the volatility that we saw in almost all asset classes. And it's really being driven by this trade war that is in full effect right now going on between the US and just about every country in the world. And that level, I think, of uncertainty and, just the day-to-day, how this thing is playing out with the policies and changes and flip-flopping, it is really giving investors, I think, a pause to say, look, we are now dealing with unprecedented, uncharted territories here. I mean, think about the last time somebody went down the road of this, full-blown tariff trade war. I mean, we're talking about 100 years ago. So it's not like it's something you can just kind of go back in your recent history and model out. I think the other thing that is giving gold a real bid here is this. It's almost impossible to price risk in this uncertain environment. And in the absence of being able to price risk, I think gold is going to be well supported here. There are a number, I think, very powerful buying groups that are helping to push gold higher. Last year was all about central banks. This year, I think we've got kind of a new group of buyers that have reappeared after being absent for largely 5 years, and that is Western investors are coming back to gold because of these emerging portfolio risks. The last group that's really starting to flex is Chinese retail investors. We looked at some data last week showing inflows into Chinese listed gold ETFs, and they are off the charts right now. So as a retail investor in China, which are obviously very large savers, they're looking at potential currency devaluation and trade wars, and they're flocking to gold. So you've got a lot of buying groups that are really pushing all at the same time. And I think that's why gold's at an all-time high.
Right. Now, you've got groups like UBS, Goldman's, etc., predicting 3,500, 3,700 gold by the end of this year. As a retail investor, that's, I guess, what I'm buying into. We talk about, economic uncertainty, etc., and store of safe haven, but this isn't an asset class that necessarily can generate you interest. It's not interest bearing, say. So am I buying into emotionally because of what's going on, or is this like an investment class that can actually give me a return at some point down the line?
Yeah, I mean, if you look at the long-term track record of gold, it has done very well. It's done about 8% per year over decades. And it has obviously been a store of wealth for millennia. And right now, if you think about what the number one competitor is U.S. Treasuries. U.S. Treasuries have historically been a safe haven in these tumultuous times. The other safe haven assets been things like the U.S. dollar or the Swiss franc. Now, what you've seen in the last few weeks is the U.S. dollar and U.S. Treasuries are under selling pressure. And the reason, I think, is pretty simple. People are starting to lose faith in both of those asset classes, given what's going on the trade war front. So I think the market learned a pretty valuable lesson that the bond market wields enormous power. And if sovereigns and other entities decide they don't want to hold U.S. Treasuries and start selling them in the market, we saw that a very immediate reaction with bond yields spiking last week, which then I think really helped gold, hit all-time highs because it did incredibly well as bonds were selling off. If bonds are selling off at the same time as stocks are selling off, where do you go to other than T-bills or cash? And that's, I think, why gold is also getting a really good bid here.
Right, and talk about gold's role in terms of a hedge against inflation or currency devaluation, because we talk about geopolitical risk, we talk about these tariffs, trade wars, etc. It's getting complicated out there for the average retailer.
It's complicated for all of us. I think everyone is struggling to figure out how this is going to play out. The one term that you're starting to hear more and more about, and it's a term that hasn't been used for decades, and so it's not familiar to most investors, it's stagflation. And what is stagflation? Stagflation is basically a situation where your economy is kind of stalling out, where it could have flat to negative growth, and you have excessive inflation. And that is one of the scenarios that economists and investors are starting to think about that could play out in the coming months as the economy starts to slow down because of tariffs and stalled business decisions. At the same time, costs of goods are going up because of tariffs. Now, when was the last time we had stagflation? Well, it was in the 1970s, and most of us obviously aren't old enough to kind of invest in that period. But I can tell you, if you go back in history and you study that period in the 1970s, what did incredibly well? It was gold. And I remember early in my career when I would talk to some of my mentors, and they talked about gold, and they said it was the one thing that saved us in the 1970s. And that lesson never was lost on me. And it feels as though we could be entering a stagflationary period which is another reason why gold is doing quite well.
Right. Okay. We're going to leave gold because I just want to introduce this to an audience that perhaps has not considered it before. So there's a whole bunch of topics to consider and try and understand, and we can do deeper dives later on, and we will put some links to some other programs we've created and which answer some of those questions. We know gold is often mentioned with silver. Let's explain the historic relationship between those two.
Yeah, it's a great question. Obviously, silver and gold are both precious metals, but they have some key differences. Gold is first and foremost a monetary metal. Central banks accumulate and hold large amounts of gold as part of their foreign exchange reserves. On the other hand, silver has more of a hybrid role. It is part monetary metal and it is part industrial metal. And those industrial applications, range from electronics to medical devices to obviously solar panels, which consume about 20% of the world's silver supply every year. So it will have different drivers of its supply and demand. And right now, what you're seeing is gold is really taking charge because that monetary element of it is really winning the day. And silver has been lagging. Silver is still a long way off its recent high. It wasn't recent, I should say. It was well over 10 years ago now. But the highs that it reached in 2010 and 2011, around $50 an ounce, and we're still sitting at sub $35 an ounce. So silver is very, very cheap on an absolute basis, and it is even cheaper relative to gold, given the ratio of gold to silver has really blown out. Now, hopefully, our expectation is silver usually gets dragged along. Gold kind of starts the race, and silver gets pulled along. We're still waiting for that to happen. Silver has obviously done better in the last 12 months, but it is lagging. It is still underperforming gold, and it's because it doesn't have the same safe haven qualities that gold has. But we would expect silver to get a bit of a push here and perform better. But it is a very different metal. We also tend to find a substitution effect comes in, which means when the price of gold gets a little bit lofty, think about places like India. They tend to buy less gold and shift their buying behavior to silver. And we're seeing very large amounts of silver being consumed by retail investors in India right now.
Right, and let's just have a quick look at the kind of profile of the investors. So gold in relation to silver. I mean, silver is, I guess, is a slightly, as you say, affordable investment. It's a sort of smaller entry level on the physical side. But again, how else asked you this about gold? How can people invest into the silver commodity, silver metal?
Yeah, well, Sprott has the second largest physical silver fund in the world, the Sprott Physical Silver Trust, which is just recently crossed through $6 billion US in size. We have been one of the largest buyers of silver in the last 5 years. It has proven to be a very popular choice for investors that don't want to deal with the inconvenience of having to buy physical silver, which is very bulky. And physical silver can also trade at very high premiums to the spot price, meaning there are very large markups on the price of coins and small bars. So the exchange listed option, which is PSLV, that's the ticker on New York and Toronto, has proven to be a very popular choice for every kind of investor. We have very large institutional investors right down to the do-it-yourself individual investor.
Right, so that profile, a gold investor could equally be the same silver investor. There's no kind of difference or attitude towards the metal.
Yes, absolutely. We find many times investors own both. I would say gold is a bit more skewed institutionally in terms of its ownership profile, whereas silver is more skewed towards retail, high net worth investors.
Right. Okay. And let's come on to the kind of industrial component. I think for a long time, silver talked a good game, but didn't really deliver. But with the expansion of the kind of green energy transition, solar panels have become de rigueur. I think finally silver is able to kind of, I think, justify the industrial demand component. 20%, you say. Is that where we were at for the number?
Yeah, industrial demand's about half of silver use, with solar
Half.
being 20%.
Sorry.
So
Okay. Thanks for
solar
clarifying.
has been the most the fastest growing industrial element is clearly solar, and the reason is that China is flooding the world with very cheap solar panels right now, which they are deploying at record pace, but also other countries as well.
Okay. And how do we kind of read the silver market? It's slightly more erratic in the sense, well, certainly if you look at pricing over the years, but also in terms of production, because there's a lot of silver produced as a byproduct in mining, so it's kind of hard to work out what's coming through. So how do you view its ability to serve as a kind of hedge against inflation when you don't know how much is actually going to be produced each year?
Yeah, it's a really good point. I mean, there are very few pure play silver mines left in the world. Most of the silver will come out of a mine as a byproduct of gold or copper or lead or other base metals, and so it is less predictable, and the production can be sometimes more driven by those other elements. You know, whether those elements have high prices, incentive pricing to expand production, and often silver is just a small byproduct along the way. So the silver supply is, I would say, more subject to ups and downs. The data that we look at suggests that silver is in a supply deficit. A lot of silver gets consumed and doesn't get recycled, whereas most gold that's ever been produced, is still sitting in someone's hands or someone's vault. So gold is given its value, is mostly still in place from the day it's been mined.
Right. And do you feel that it's obviously had a very big historical significance in the marketplace? Do you think that's waning any? Do you think is it still going to kind of retain its ability as gold seems to, as a kind of form of currency? And we talked about the industrial use, but in terms of a store of value with a new generation?
Yeah, I mean, silver is obviously, does not have the same store of value that gold has historically. I think the numbers bear that out. Central banks do not hold large amounts of silver as part of their FX. I think part of that is just it's not as practical given the sheer volume. I can tell you when I go into our silver vaults, it is enormous. The value to volume relative to the gold vaults that we operate, but it is still a very important industrial metal, and its role in many new technologies continues to give silver a bid. What we don't have with silver is obviously that central bank buying tension like we've seen with gold over the last 3-4 years.
Right. And coming back to that kind of market volatility, and there's kind of, well, I think kind of frequent price swings. The market's obviously is used to that. There's a kind of tolerance there, but does it provide, again, retail investors opportunities for gains? If you understand how it plays out, maybe you can invest accordingly.
Yeah, for sure. I mean, silver is obviously very cheap on both an absolute and relative basis to gold, and it is more volatile, so it is something you can trade a little bit more. Right now, I think silver is getting ready to join the party with gold. It just needs a little bit of a push. We saw the same thing play out in 2020 during COVID when the early move was buy gold. And then what happened a few months later, silver kind of caught up and kind of slingshotted right by. So, it's hard to predict whether that scenario will play out again, but that historically has been the pattern between the two metals.
Right. And people always talk, I think you're referencing the kind of silver gold silver ratio. Is that something else that people should be looking at, trying to understand how it's working?
Yeah. So what that ratio tells you is basically, it gives you the equivalent ounces of silver that you can buy with 1 ounce of gold. So you basically divide the two numbers, and that ratio gives you a sense of how they are trading on a relative basis. And right now, that gold silver ratio is very excessive. I think we're obviously around 90 times. So you can buy 90 ounces of silver with 1 ounce of gold. And that range, historically has been all over the place. It could be as low as 40. I think right now we're at extreme levels of 90. So when the price of silver is very low relative to gold, you're going to have these very high ratios, which you're seeing right now. So it is an attractive on a valuation basis, and it's just a matter of waiting for those catalysts for silver to kind of join the party.
Right. Okay. So again, for people coming into this space, a lot of topics to maybe look at, and we'll kind of again put links to some of those things that we've kind of talked about in the past to help you understand those things. Right. Going to get onto uranium. Right. Oh boy, oh boy. So gold and silver. Gold's had an awesome time. Silver's had a good time. It's come off a little bit. Likewise, uranium's come off, and I'd say not a bit, a lot. What's your read of the situation out there?
Uranium has been very frustrating for us and our investors over the last few months. It's clearly in a bit of a logjam situation, and that logjam I think can be explained by a few things over the last, say, 6 months. And that's really being driven by uncertainty related to tariffs. We're finally getting some clarity there, which I'll elaborate on in a moment. But obviously, uranium is very geopolitically charged in terms of its global supply chain. And given everything going on right now in the world, there has been concern about how it's going to play out. And so there are a few elements that I'll break down. First of all, a few months back when Trump won the presidency, there was some concern about how pro-nuclear is this administration going to be. I think it's very clear they are very pro-nuclear, as most Republican administrations have historically been. But there, as you know, everything in the federal government is being reviewed. That includes the Inflation Reduction Act, the Loan Programs Office. These are programs that have provided a lot of financial incentives to the nuclear industry. And utilities have been kind of on the sidelines waiting to see if those programs were going to be adjusted. Tariffs obviously were another big item, given the U.S. imports almost 100% of the uranium from other countries. Now, the good news there is that tariffs in uranium are largely a non-event, meaning uranium has been largely exempt from tariffs, and that, I think, certainty is going to help break the logjam. Now, there is a recent development just yesterday where critical materials are now under the Section 232 review. That includes uranium. But the reality is, in the United States, they have the largest fleet of nuclear reactors in the world. They require almost 50 million pounds of uranium every year as their fuel. And production in the United States might hit 1 million pounds. So you're talking about a supply chain that is completely foreign-based. Putting tariffs on it, obviously, is kind of self-defeating because you don't have any alternative source for the fuel, and you clearly can't substitute it or thrift it. So we feel as though the uranium market is starting to come out of its doldrums. The spot price, obviously, as you referenced, has had a pretty meaningful correction in the last 12 to 14 months. It's starting to find a footing at around $64, $65 a pound. Now, in sharp contrast, the term market, which is obviously the much bigger of the two, and the term market, for everyone's benefit, is where utilities go to buy uranium under long-term supply arrangements. That price is actually not just firm, but it went up 20% last year. So there's a real kind of dichotomy between the term market and the spot market. The term market has been very firm. There hasn't been as much contracting as everybody has liked, which has been a negative signal to the market, but it has been firm, and it feels as though utilities are starting to come back to the market to procure. Now, why is that? Well, they've got some certainty on tariffs, but I think more importantly, it's about time. Utilities cannot be caught without fuel, which means they have to constantly replenish what they're consuming. And if you drag your feet and aren't procuring, you're basically just kicking the can down the road. Now, uranium is a really unique commodity in that, irrespective of trade wars, recessions, stagflation, etc., it is largely immune to those economic forces because its demand is completely inelastic, which means utilities have to buy it no matter what the price, because there is no alternative fuel for uranium. So it is just a matter of time before utilities come back to market. As I said, we're starting to hear through our channels that they are starting to sniff around. We hope they come back to market and start buying with some clarity coming around tariffs. And it feels to us that the current pricing environment represents a very interesting opportunity for investors, given the price has gone from about $100 a pound down to 64.
Okay, if you look back 5 years and the kind of conversations that we have all had in the uranium space in the last 5 years, I mean, do you kind of slightly wince at some of the commentaries, some of the catalyst moments, some of the narrative as the story has evolved? Would you think actually it's still the same as it ever was, if not more so? How do you view it when you look back?
Yeah, no, it's a really good comment. If you think about the bull case for uranium, it is only strengthened, irrespective of trade wars and tariffs and all these other things that are noise, quite frankly. It has only strengthened. So what are the two signals that the market is fixated on right now? The spot price coming down over the last 12, 14 months, and utilities deferring purchases in an environment of tremendous uncertainty for themselves. Now, if you take a step back and you say, is that spot price correction a real signal, or is it noise and subject to some one-time factors that I think are washing through the market? And that's our view. We do not think the bull market is over. We do not think that the correction in the spot price is the right signal to be focused on, and that investors with a time horizon that's more than 3 months or 3 days needs to think very differently about the longer term perspective here. Because if you take a step back and you look at the supply deficit that's building, and it's being talked about, I think, ever increasingly, it is meaningful. And this industry is really pinning its hopes to plug that supply gap through the development of just a few mines in the world, which we know is very challenging and time constrained at times. So the market is kind of betting that there will be enough supply, particularly in the next 2 to 5 years, to meet growing demand. And there's still a lot of uncertainty as to where that production is going to come from. There was an industry conference about a week ago in Montreal, Canada, and that was the main theme, that from about 2028 to 2035, the supply gap looks kind of scary. And utilities, I think, need to refocus their efforts on security of supply and move away from all the noise and distractions that have largely paralyzed them over the last 12 to 14 months.
I'm glad you say we've written like 3 pieces on this, the supply issue. We've said for a long time now that if we didn't get any more demand in the market, it's fine. We got enough. What we don't have is line of sight to where the supply is coming from, when it's coming, and at what sorts of volumes, because it's quite clear from the Red Book that the data suggests that the companies who have been talking a good game of getting into production by now have not. They've missed their targets, not just by a little bit, by a lot. And the supply is going to be a real issue. But the slightly more worrying thing has been, and this, I guess, was coming with the previous question, which was with hindsight, this talk of energy transition, etc., carbon capture, and all this very sort of agenda-driven narrative, it kept people from focusing on the fundamentals, which is where's this supply going to come from? And I think we need an adult conversation about the total energy market rather than where nuclear fits in, because nuclear, it's not instead of, it's an as well situation.
Yeah,
Don't know how you feel about that.
Yeah, I totally agree with that. And I think the term that the market should be focused on is energy addition.
There you go.
That is the theme of the day. The load growth in many markets continues to improve after being largely stagnant over the last 20 years in a lot of Western markets. But let's just take a step back and talk about demand for uranium. I think there was a lot of excitement, which drew in a lot of hot money, 6 months ago when some of the the hyperscalers announced deals with nuclear energy utilities, and that was very exciting. And we got excited
So
about it.
define hyperscalers for
Sure, hyperscalers
people.
are like the Googles and the Metas and Microsofts of the world that are developing very electricity intensive artificial intelligence data centers. And up until now, they have largely been focused on powering those data centers with clean forms of energy, such as solar and wind. And they came to an inflection point last September and realized they had no way of meeting the forecasted electricity demands from their planned buildouts with renewables only, and they needed to pivot to another fuel source, which was nuclear/uranium. And the market got very excited about that, did we, because what it will do is not translate an immediate demand for uranium, but what it will do will help prolong the bull market we're in today, as the money from these very deep-pocketed companies helps to fund the next generation of reactors. And that's been a bit of a missing link. It's the risk capital that's willing to fund first of a kind technologies. And these hyperscalers are obviously very accustomed to operating highly disruptive business models, new technologies, etc., as opposed to very traditional conservative utilities, which did not want to be first of a kind to help get these new companies and technologies on their own 2 feet. So I think when generalists realize that, hey, this isn't going to translate into more uranium demand in the next 6 months, they just kind of moved on and went on to some other thing. But if you think about the next 5 to 8 years, as the money is deployed, these technologies are commercialized, this is all the cherry on top, because you have the backbone growth being driven by places like China and India and other markets. You've got Western markets that have basically pivoted to, we're not decommissioning what we have early. We're actually going to extend the lives of many of our existing plants. And by the way, we're in the process of turning on 3 shuttered nuclear power stations in the United States as we speak, because the value of this electricity, which happens to be zero greenhouse gas emitting, is hugely valuable to these AI data center companies. So, obviously, some hot money has come and gone. We think some money is actually flipped to shorting the sector, which means they want it to go down in value. But for investors that have a medium to long-term time horizon, the fundamentals in uranium have not changed one bit. They have only strengthened.
Right, but the hyperscalers don't like to share. They're doing this for themselves. It's their money for themselves. How do the utilities react? How do they learn? How do they access capital to kind of build out for the regular folks like you and me who want cheaper electricity to their door? Because there's a kind of, if I look in North America more broadly, there's a kind of failing grid system. I should say some reactor extensions, etc. Is the government going to step in? Is that the right thing?
Well, there were clearly elements of the Inflation Reduction Act that gave production and investment tax credits to these utilities to basically keep their plants on for longer and to refurbish them and go for life extension. So that's all happening, and it's working out just fine so far.
Downstream.
I think the challenge has been for utilities, and these are the publicly traded ones, to really stick their necks out and say, okay, we're going to build more new capacity. It's great that you're getting life extensions with what you got and refurbishing what you have, and perhaps even turning on plants that have been closed for 2 to 5 years, which is what's happening right now. But for them to kind of say, hey, we're going to take the financial risk and build new small reactors or large scale reactors, they're just not there yet. And the hyperscalers are the ones willing to make those initial investments. And I would also say places like where I live in Ontario, Canada, Ontario Power Generation, they are making those investments right now as we're building 3 new small modular reactors on site of an existing power station. That's all going to, as those technologies are proven and scaled, I think that's when you're going to see other people step in and say, okay, those projects have been de-risked, those supply chains are being built. Now it's safe for us to make those investments, but we don't want to be first. We'll let someone else go. And I think that's always the challenge with some of these new technologies is who has the financial, strength and balance sheet and risk tolerance to be the first.
Yeah, for sure. Risk averse, usually utilities. Okay, so again, you talk about a little bit more demand, but this isn't as we said earlier, this isn't necessarily a question of seeing the demand there. It's a question of utilities saying, look, given the kind of energy pie chart and where nuclear sits in that, it's a small slither of looking at anywhere between 10 and 17%, depending on who you believe. But that's not a case of that percentage increasing. That's a case of the whole pie is growing. So therefore, nuclear's kind of got to step up. So given it needs to do that, utilities going to have to decide where it puts its money. Is it going to be behind nuclear? Is it going to be behind renewables? Is it going to be behind conventional gas plays, fossil fuels, which have not recently been, fashionable, but I think it's to say the adults are back in the room now. And there's going to be a conversation about we need all of the above. So utilities need to make some decisions, but uranium companies, you buy physical uranium from the market. That's we should talk about people investing in Sprott physical uranium trust, but they can also invest in ETFs. They can also invest into directly into publicly traded companies themselves in the equities market. How would you suggest people, retail, play this space in terms of investing?
Sure. So on the uranium space, space, it really comes down to two paths. Do you invest in a vehicle that owns physical uranium to play the commodity in the spot market? And obviously, we've got the largest vehicle in the world that does that. Or do I take on more risk because let's face it, the equities are more volatile? Do I invest in a basket of the uranium miners? And we obviously offer a few ETFs on both sides of the Atlantic that do that. And that's been a very popular way for not just individual investors, but even institutional investors that say, look, I don't want to pick one or two of these things. I don't have the technical expertise, or I don't want to take too much company-specific risk. I will just buy a basket of these things in an easy-to-trade ETF. And those have been very popular investments for all kinds of investors. And we're starting to see in the last few weeks new capital coming into our uranium mining ETFs, which is a good sign. I think people have seen the recent price correction that we've experienced since November and said, okay, it feels a little overdone. Market dynamics are still very positive for uranium. Yes, as you said, we've had some supply challenges with bringing on old mines that were on care and maintenance for a number of years. They're working through those issues. But the price in the term market has been very strong, and that's obviously where utilities are going to be buying material from these emerging producers. So these ETFs, I think, are a very easy way to diversify across a basket of companies, as well as get some exposure to the physical uranium itself, which is often a component within the index.
Right. Okay. So that's what you recommend. I mean, I think it'd be remiss of me not to ask. I mean, a CEO has said that it's complicated out there because potentially companies like yours might be sort of dumping, might be dumping physical uranium back into the market, and that just adds to this kind of shorting risk, this geopolitical risk, etc. I mean, can you confirm whether you have or have not, or even if it's in consideration?
Yeah, there's definitely some rhetoric out there, and we think it's being fanned by short sellers in the market that are looking at the cash position that the Sprott Physical Uranium Trust is currently sitting on and saying, wow, it's getting low, guys. And what if they need to start selling uranium into the market? And the reality is that, the vehicle is coming up to 4 years since its inception. We have not sold a single pound over that period of time. And I think this is just a new thing for people to digest. Now, if we get to a situation where we don't have cash to run the vehicle, yeah, theoretically, we may have to sell some uranium in the market. We do this with our other funds from time to time. But I want to make sure people have the right perspective. The vehicle right now is sitting on 66.2 million pounds of uranium. And so the stockpile is huge, and the stockpile is sequestered. And this narrative of, oh my God, they're going to start selling it all to the utilities and they'll just stop buying because they'll think that there is a huge stockpile of material that are available to them, I think is just disingenuous. And we're obviously working to address that. We're entering into some transactions as we speak to bolster our cash position through doing some transactions that generate income in the fund, because there is a lot of strategic value of having the stockpile to utilities and producers, which we help out from time to time. And so I think it's very overblown, overreactionary. Yes, I know people are a little bit tense right now and anxious, but I also think it's disingenuous that the short sellers, I think, are fanning a lot of these rumors.
So let me be really clear with what you just said. You are looking to find ways to introduce capital into the Sprott Physical Uranium Trust, which may involve utilities and sector strategics. Does that mean putting product into market?
No, what I was referring to specifically was helping the marketplace with their mismatches of inventory. And what I mean by that is we will enter into transactions with utilities and or producers or traders by swapping title of material from one location to another. They're called location swaps. And because we're sitting on this big strategic stockpile of material, we often get called by these folks saying, look, I need material in the United States. I have it in France. Would you exchange title to me and we'll give you a financial incentive to do that? So it's really moving title between our different piles. And we get called by utilities, traders, and producers who don't want to physically move the material from one storage facility to another and would rather swap title to an agreed upon transaction.
Right. Okay. Just wanted you to be clear because I don't want no misconception. I think to use your phrase from earlier. So just okay. So we're looking at energy addition, I think you called it earlier, rather than energy transition. Does that also suggest that you think there's going to be there's going to be a level playing field, i.e., end to subsidies for renewables? How do you kind of see nuclear's ability to have a sort of fair crack at the whip here?
Yeah, well, I think it's fair to say that industries like solar and wind for 20 odd years got significant incentives and subsidies in many different places of the world. And the reason was simple. The costs didn't work. And so you needed to stand those industries up to get them to scale. That's done. The industries are self-sufficient. Now it's all about economics. Can they competitively compete on the grid? And so what you're seeing is governments are shifting those subsidies away from wind and solar as they've matured. And the second thing we're seeing is not so much subsidies are being thrown at nuclear energy, it's that the penalties on nuclear energy are kind of being removed. And so adverse government policies, premature closures of plants, that's all fall by the wayside now. And so we view nuclear as being more on a level playing field and able to compete on its own basis right now with some of the other technologies that have been heavily subsidized over the last 20 odd years.
Okay. And just finally, just finish off on one of your products, which the uranium, the ETS, is obviously you get a basket in there. There's not a lot of new players, and there's a sort of wide range of explorers, all struggling for cash, it seems. There's been a few players that have managed to time this well and doing roll-up exercises, but not a whole bunch of new production. Even the producers are struggling to hit the numbers that they've been advertising. So do you think the West is going to be capable of financing growth, not in equities, but growth in terms of pounds out of the ground? And how do you sort of, I guess, with your ETFs, profile them and look at how much you allocate to each of those companies? Because there's a lot of talk, not a lot of doing, it seems.
Yeah, well, it's like mining to begin with is a very challenging industry, when you couple the fact that over the last 10 plus years, the industry was basically shut in, meaning a lot of uranium mining was not economic, including some of the best performing mines in the world. And, when you have a period that lasts, 10 years in mining, that is capital intensive, and you starve it of capital, you have to deal with a period of atrophy where the supply chains disappear, the skilled labor forces disappear, they move on to something else. And that's one of the big challenges of this sector. It's a huge opportunity, but it's a huge challenge in terms of attracting capital to actually move these projects forward, again, after being dormant in some cases for 10 plus years. Now, why is capital going to come to the sector? Well, capital needs a sufficient rate of return on their investment. And that's only going to come if the projects work, obviously, but it's only going to come if there's demand and price signals that make sense. We obviously see very good demand signals from utilities around the world as they're, recommitting to the technology, as well as new countries building it for the first time. And, China is obviously building 4 to 6 new reactors per year. Now, the price signals, we've obviously come a long way from where we were in 2020, 2021, when the price of uranium was still in the 20s per, dollars per pound. We're now in the 60s, and the term market is at $80 right now. So the price has responded. Is the price sufficiently high enough to incentivize new production? Not universally. We've obviously seen some companies just recently saying they're pausing the development of their projects because the price in the market right now is not sufficient. So that's one of the big challenges here, but it's also one of the opportunities that, you've got a critical material that the marketplace needs, and the supply response is going to be choppy. And that's exactly what we've seen in the last few years. Some of these growing pains are worked through, which is positive. But, greenfield production is the big challenge over the next, let's say, 5 to 6 years. We need to build new mines. And that's going to require, the right deposits, the right management teams, and obviously sufficient capital to build those projects.
Do you have faith that will happen?
We're very hopeful it happens. There's obviously, we've been waiting a long time. The sector has been waiting a long time. I think the industry, these utilities and governments absolutely need these projects to come to market. There's been a lot of talk about, streamlining permitting and all this rhetoric. It's rhetoric. We need more tangible proof that governments are willing to, I don't mean cut corners, but 4 years to do an environmental assessment on a new project seems way too long to us when there is critical demand to, strengthen production in obviously jurisdictions that are, most importantly in Western markets.
Right. And do you think that's part of the reason why utilities are a little bit nervous with regards to nuclear as the solution, when the feed for that the uranium team is not doing its thing? Is that a reasonable response from the utilities?
I do think it is a consideration when they think about where they have to source uranium. It is heavily concentrated in a few mines in a few countries. And I think in the last 3 years, they've thought very differently about how and where they're securing supply. The one region of the world that continues to buy a disproportionate amount of production is China. China is not slowing down any of their purchases. And the reason's very simple. They have a long-term focus. This is a strategic objective. They will undoubtedly have the largest fleet of nuclear reactors probably by the year 2030, lapping the United States and continuing on from there. So it is the one group that is, irrespective of what's going on in the world, the noise, the pricing, they just keep buying. Some of the Western utilities seem to be, dragging their feet and not taking the same aggressive position that their Chinese counterparts have taken the last few years.
But they must believe there's a plan B and a plan C if they are dragging their feet. I think that's the question that needs to be answered. And I guess also the narrative which needs to be introduced into the conversation around energy transition, energy addition, moving forward. But in the short term, you see potential. You have no qualms about what Sprott Physical Uranium Trust is doing, what uranium ETFs are doing. You feel there's money to be made.
Yeah, we think obviously the recent sell-off was overdone. There's obviously been a lot of noise in the market and some selling in the market, which I think put undue pressure on the spot price. It feels to us that's cleared and the market has found a better footing. It's been very stable, the price of uranium the last few weeks, when everything else has been incredibly volatile, and many commodities that are more industrially focused have obviously sold off, including the energy complex as well. So it is actually holding its own in this environment of downward pressure and extreme volatility, which I think gives us some comfort that it's found some support here.
Okay, well, let's leave it there, because I think that's fairly kind of high level introduction to those three metals. And like I say, we'll provide additional information for people. Maybe we can come back to you, John, and maybe get into the weeds a little bit around each of those. Appreciate your time today. Thanks, and we'll see you soon.
Yeah, thanks for having me on. Great chat. And I would encourage your viewers to go to Sprott.com, have a look at our insight section, our podcasts, our commentaries. We spend an enormous amount of time on investor education, which we think is really critical.